Well, good morning and welcome to the Reserve Bank. With me, I've got Grant Spencer, the Deputy Governor and Head of Financial Stability, who I'm sure you're all very, very familiar with. New Zealand's financial system is sound and operating effectively, but faces three significant systemic risks. Auckland's median house price is 60% above the 2008 level, and house prices in Auckland have been rising particularly rapidly since late last year. Relative to income and rents, house prices in Auckland are far more elevated than anywhere else in New Zealand. The region's house prices have become very stretched, increasing the risk of financial instability from a sharp correction in prices. A second area of risk relates to the dairy sector, which is experiencing a sharp fall in incomes due to lower international prices. Many highly leveraged farms are experiencing negative cash flows, and the risks will become more pronounced if low milk prices persist beyond the current season. The third key risk arises from the current very easy global financial conditions. Prices of financial and real assets are becoming overextended in many markets. There's an increasing risk that current conditions unwind in a disorderly fashion, disrupting the cost and availability of funding for the New Zealand financial system. In response to growing housing market risk in Auckland, we are announcing proposed changes to the loan-to-value ratio policy. Taking effect from 1 October, residential property investors in the Auckland Council area using bank loans will need to have a deposit of at least 30%. The existing speed limit for high loan-to-value ratio borrowing outside of Auckland will be increased from 10 to 15% to reflect the more subdued housing market conditions outside of Auckland. The existing 10% speed limit will be retained for loans to owner-occupiers in Auckland at LVRs of greater than 80%. The objective of this policy is to promote financial stability by reducing the rate of increase in Auckland house prices and improve the resilience of the banking system to a potential downturn in the Auckland housing market. While the new measures aim to moderate housing demand, policy to ease supply-side constraints in Auckland remain the key to addressing the region's housing imbalance over the longer term.
Later this month, the Bank will issue a consultation paper providing further details and seeking feedback on the new LVR proposals. With the proposed start date of the policy on 1 October, we expect the banks to observe the spirit of the policy and not seek to expand high LVR investor lending in the interim period. Given the importance of encouraging residential construction activity in Auckland, the new LVR restrictions will not apply to loans for the construction of new houses or for buying apartments off the plan. Consistent with the new LVR policy, the Reserve Bank is establishing a new asset class for residential investor loans. Banks will be expected to hold more capital against this asset class to reflect the higher risk inherent in investor lending. Following a lengthy consultation, we have decided that the definition of a residential investor loan will be any retail mortgage secured on a residential property that is not owner-occupied. We will release a report later this month setting out the details around the new asset class, including the proposed capital treatment for residential investor loans. Given the broader risks facing the financial system, it's crucial that banks maintain their capital and liquidity buffers and apply prudent lending standards. Later this year, the Reserve Bank will be reviewing overall bank capital requirements in light of both global and domestic developments affecting the safety of the New Zealand banking system.
Governor, how effective will this be? Have you done any modelling on what sort of impact this would have on Auckland house prices?
Yes, we've done some modelling, and that'll come out in the consultative document that we'll be releasing soon. In essence, we think that it may well reduce property transactions in Auckland by something like about 8 to 10%. Possibly reduce Auckland house price inflation by something like 2 to 4%, maybe even more than that. And then the measures, of course, we're raising the LVR speed limit outside of Auckland, and we think that the volume of house sales outside Auckland could pick up by about 4%, and maybe house price inflation by around 1%. But we'll have more details in the consultative document.
Why are you so convinced that it's property investors that are the problem here?
Well, we know the dynamics of the Auckland market, fairly well. We've followed it closely. I mean, we see house price inflation in the latest RINES data. We tend to look at not month-to-month movements or 1 month over a year. We tend to look at the last 3 months over the same period last year because we feel that gives us a better feel. And Auckland house prices are up 17%. You see the house price to disposable income ratio is up 7.4, it's 4.2 in the rest of the country. You see rental yields in Auckland are now down to around 3%. They're at a historic low or a record low, whereas for the rest of the country they're around about the 10-year average. And we see that investors, to a significant extent, are driving quite a lot of the market activity. If you look at the share of investor sales, if you like, prior to the introduction of the LVR speed limits, the investors were accounting for about 35% of housing market transactions. That's increased to 40% in the Auckland area. So that's quite a step up. We see that investors, around half of the investor lending is taking place at LVRs that are greater than 70%. And if you look at the survey that ANZ Bank did late last year, it basically had investors thinking that house prices over the next 5 years in Auckland would pick up something like 75%. So, investors are driving quite a lot of this market activity.
And did you feel that this was getting out of control and that it was starting to look like a 1987 sort of situation with the share market? Is that the type of environment you were worried about?
Well, we're worried about, the fact that house price inflation's, as I say, in the Auckland region, growing at 17%, and for the rest of the country, it's growing at 2.1%. For the rest of the country. We don't use words like sort of bubble. You won't hear the bank talk about rockstar economy and things like that. But no, we've become seriously concerned about the financial risks or the financial stability risks posed by the Auckland housing market.
I think it's important to add that, we've said all along that the prime driver of the Auckland housing market pressure is the supply shortage, the physical shortage and the inability of supply to keep up with the large numbers of people coming into Auckland. But we think there's an overlay on top of that underlying shortage where this increasing participation of investors is exacerbating the situation.
What's changed that's meant that you've now gone from a regional specifically targeted program, whereas you seem to indicate that you weren't interested in those because of the potential unintended consequences.
Well, if you look at when we introduced the LVR speed limit, it wasn't just Auckland property prices that we were concerned about at that time. I mean, if you looked at what was happening in other regions like Otago Lakes or Nelson or Taranaki or Hawke's Bay, at the time we announced the introduction of the speed limit, so around August 2013, house prices were growing in those regions, somewhere between 5 and 9%. So it wasn't just an Auckland issue at that point that was concerning us. We felt that in an environment of very low interest rates, that house price inflation really could start moving in other areas. We also found that we've gathered more information from banks about their type of lending. We feel that the banks now have more familiarity with running loan-to-value ratio regimes. And the other thing is that the strength of the Auckland market is just now so much more marked.
In terms of the issue of distortion at the boundary, we've tried to mitigate that risk by drawing quite a wide boundary in terms of the definition of the Auckland region, taking the whole Auckland Council, broadened council region. Then you're getting quite a wide cut of the boundary rather than a boundary such as the old municipal urban limit, which is much closer to an urban definition. So, the way we've drawn it, we're hoping to minimise any distortionary effects around the boundary of the policy.
And are you worried that there'll be any sort of attempt to try and get round the rules, rorting it with other lenders coming into the mix to try and get round it?
Well, there are always those issues, and we'll be putting out a consultation document in a couple of weeks that talks around the approach we take to try and mitigate those sort of risks.
I mean, one of the things with the loan-to-value ratio speed limits, we didn't see the sort of financial disintermediation that many in the financial system felt might occur. But as Grant says, we'll be covering some of these issues in the consultative document.
How has domestic data picture in the past few weeks changed affected the Reserve Bank's rate outlook?
Do you mean in respect of monetary policy or what?
Yes. The jobs data and wages and house prices.
Well, we'll leave comment on that to when we do the monetary policy statement. At the moment, we're just in the process of putting together our forecasts for the June monetary policy statement, so we haven't had the internal discussions in detail yet.
Why do you see the dairy situation as a systemic risk, given how concentrated high debt levels are in that sector?
I think, it's because, in essence, the dairy sector is so critical for the economy. I mean, if you look at dairy exports, they're about a third of merchandise exports. And, we've seen a very dramatic decline in dairy prices since February last year. We thought they were picking up. We're encouraged by some of the auctions earlier this year, and the last 4 auctions we've seen have been negative. But dairy debt has trebled since 2003. I mean, it's roughly 34 billion at this point. We've done quite a lot of work with Dairy New Zealand looking at farm indebtedness, and we believe that 30% of that debt is concentrated amongst the most indebted 10% of the farmers, or roughly half of the debt is concentrated amongst the most indebted 20% of farmers. And at the current payout, or the forecast payout of $4.50, we believe that something in excess of 35% of dairy farmers have negative cash flow. So a critical issue is to what extent will dairy prices pick up over the next season, and we've been giving quite a lot of thought to that issue.
Two data-related questions here. One is to do with what is in the report, and that's around, you've got quite a bit of comment there about the extent to which investment seems to be following capital gain in Auckland, and tied in with A, the focus on Auckland, and B, those ratios with incomes, etc. Does your data suggest that, and I guess I'm referring back to Mr. Spencer's speech earlier in the month, or last month I should say, does your data suggest that perhaps other aspects of the policy apparatus aren't picking up the extent to which investment with the goal intention of capital gain is going on?
Well, I think, I mean, what I was saying in the earlier speech was that it's a complex issue, the Auckland housing market, and it is appropriate that it be addressed on a broad front. So it's not going to be solved by one policy such as this policy we're talking about here. It is important to look particularly at supply side policies, but also other demand side policies, and that includes not only macroprudential but tax policies as well. And that's why I was suggesting that the government take a look at that.
I mean, just on that, Rob, Auckland it's an unusual city by international standards in many respects. I mean, you don't see in the advanced economies, I think probably outside of Iceland is the only one I could think of, where you see one city being so dominant in terms of GDP in the economy. So Auckland generates, about 35 to 40%, just over 35% of the country's GDP. It attracts more than half the migrant flows, and over the last sort of 7 years or so, it's accounted for more than 40% of the employment growth. So it's a major issue, I think, this whole question of the housing situation in Auckland, and what our speech did in April, just like many of the speeches we've given before, tried to analyse this from a broader perspective as possible. And as we've mentioned, we see the supply issues as being quite critical here, but there are some demand issues as well. I mean, migrant flows are very strong. We're running at 56,000 on an annual basis, and interest rates are low, and we've talked about the investor activity. So what we did in that speech was also to say that we felt there was an opportunity to see fresh consideration given to policy measures to address the tax preference in terms of the treatment of housing, particularly investor-related housing that's highly leveraged. We also recognise that tax policy is a matter for the government to determine.
I appreciate pretty much all that, I think.
Yeah.
I come back to that question: is the data and the survey data you've got here, and whatever you're releasing later in the month, does that suggest that perhaps there is a greater investment with the intent for capital gain going on than is being picked up by the tax policy apparatus?
I think if you look at rental yields, they're at very low levels by historic standards in Auckland. I think they're just over 3%. As I said, for the rest of the country, they're running at around the 10-year average. Now, that does suggest that a lot of the investor activity in Auckland is being taken with an expectation of capital gains. And I quoted the ANZ survey, which talked about, in essence, an expectation that Auckland house prices would increase by around 12% a year for the next 5 years, which is roughly 75% increase. So capital gain and the expectations of it has been a factor.
Okay, second data question, and this relates to what isn't in here, but there is the ongoing anecdotal evidence that a lot of the investor activity is being driven by offshore investors bringing money in. Now, there doesn't seem to be any data on that anywhere. I don't know if you've got any data. I'd be interested in your feedback on that, and particularly as if that is if the anecdotes are correct, or even broadly correct, then your lending restrictions here are not going to have any impact at all on them, are they?
Well, insofar that a lot of non-resident purchasers are cash buyers, then macro-prudential policies will not affect them because they're credit-based policy. But we think, the credit channel is an important channel, and it has a significant bearing on the broader investor demand for housing in Auckland. In terms of your specific question, that we don't have data on the exact numbers of non-resident buyers. We can only, make inferences. We do have numbers on, the proportion of cash buyers, which gets up towards 20%. But we have a lot of those cash buyers will be New Zealand residents. We have a number on new to market sales. In other words, new entrants into the market and who are not first home buyers. And that's sort of in the 8 to 10% type of range. So, there's sort of numbers that suggest that, it could be, and we've talked about this before, the non-resident component could be around 10%, that sort of territory. We don't think it would be significantly greater than that.
I think, if you look at the numbers that were coming out of the BNZ survey that they were doing with some realtors, they were of the order that Grant suggested. But I think there are a lot of doubts about the quality or the accuracy of the information, and there's a lot going on in terms of overseas interest. It's not just necessarily out of Asia, it's out of other regions. It can also be New Zealanders who intend to return home. There is a substantial Asian presence in the Auckland market. We all know that. But 28% of Aucklanders describe themselves as of Asian descent. But I think the point that you were making, Rob, is or the implied point was, in essence, would it be helpful if this information was available? And I think it would be. I think it would be helpful if this information was collected.
In terms of the measures you are proposing for Auckland, can they control house prices in isolation, or do you see a need for additional specific policy responses from the government as well?
Well, we've talked about in the April speech, and as I say, in many other speeches that we've given, we've talked about Auckland in terms of the supply and demand side issues. And we've always indicated that the supply shortages in terms of the 20,000 housing shortfall that the council has quoted, and we've done some work on that, and the sort of flow requirement of 10,000 houses a year that the council has indicated they need for the next 3 decades, and the fact that building permits are currently running at about 7,800 shows that there are some substantial issues on the supply side. If you look at the migrant flows, just to give an example, so my net permanent long-term migration flows are currently running at 56,000 on an annual basis. We think over half of those are going to Auckland. So let's just say, roughly 30,000 were going to Auckland. The occupancy ratio in Auckland is per house is about 3.2. So you would need just 9,000 extra houses or more just to deal with the migration flow, let alone the natural increase of the Auckland population. So there's a whole lot of issues around the availability of housing, whether new housing has been built rapidly enough on the fast track solutions in terms of land that's been made available. I think there's 80 special sites at this point. There's regulatory issues, there's the cost of infrastructure, there's the densification issue in Auckland Central, for example. There are demand side issues in terms of, as I say, the migrant flow. We've raised the issue of perhaps another look at the tax treatment of housing. And there's low interest rates, there's investor activity. So there's a lot of things going on that are driving the market.
Could you elaborate on tax treatment? The speculation was, or the interpretation was that the Reserve Bank was talking about a capital gains tax.
Well, I think the language we used in the speech is that we thought that there was an opportunity to give fresh consideration to policy measures to address the tax-preferred treatment of housing, and particularly highly leveraged investor-related housing. And I think there was a lot of discussion in the media and I think within government around that question. And I think the government has looked at some issues around the tax treatment. But in essence, tax policy, as I say, is a matter for the government. It's not something that we'd wish to comment further on at this point.
I had 3 different questions. First of all, do these targeted policy for Auckland, will it give you more flexibility to keep interest rates at current low levels for longer? Secondly, there's a reference here to the real exchange rate being unsustainable, and I just wondered if you still think that it's unjustifiable. And thirdly, there's a brief reference to the rebuild in Canterbury and some risks around that, so I wondered if you could talk about that a bit. For example, how long do you think it will continue to contribute significantly to the economy, and are you at all concerned about the pace of the rebuild?
On your first 2 questions, on interest rates and the exchange rate, we'll leave that to the monetary policy statement. As I say, we're currently looking at forecasts at this point. On the rebuild, what matters in terms of the contribution to growth from Canterbury reconstruction is the increase in investment from one year to another. We think that's probably peaking last year and this year. So the aggregate level of investment over the next 2 years or next 3 years might be running at, say, $4.5 billion roughly. But the step up is this year and last year. We may well find the situation in Canterbury in years to come that Canterbury has surplus housing. That's quite possible. We're confident that the houses will be built. The insurance payouts to date are about $25 billion. There's probably around about another $10 billion to be paid. The houses will be built. House price inflation is coming down quite significantly in Canterbury. And given that there's still a lot of repairs to be done for, say, houses where the repair bill is, say, $100,000 to $500,000, then people have found accommodation, workers coming in have found accommodation, so that you could end up maybe in the medium to longer term with perhaps even excess housing in the Canterbury region.
One of the factors there in the context of financial stability was around the insurance industry, and they have continued to be surprised, to have surprises on the upside in terms of the cost of the claims, and in the sense the further the settlements get dragged out, then the greater the risk of further surprises. But so far they're 70% of the way through of their settlements, and we're hopeful that in another year or 2 that risk around the insurance settlements, the risk to the insurance sector, will be substantially reduced.
Governor, why wouldn't there be a surge in investors wanting to borrow before the October start date, and what can you do to force banks to essentially impose these rules as of now?
We expect banks to honour the spirit of what we're proposing here. So there is a lead between now and 1 October. We'll be meeting with the chief executives of the banks as we do regularly, but specifically we'll be meeting with them to discuss these measures, and also with the chairs of the board. So we'll be doing that quite soon.
But is there any legal enforceability on this until October 1? They can do what they like, can't they?
The reason is around defining what constitutes an investor. So, we've had a consultation recently around how we define this residential property investor asset class. And it was pretty clear from the consultation that the system changes that need to be made in the bank systems to make this work can't be done overnight, and it will take through to several months to get those system changes in place to allow this policy to take effect. Hence the date of 1 October rather than something sooner.
And in terms of that definition, for example, would it apply to a family batch?
It won't apply to a family batch. We regard owner-occupied property will be outside of the investor class, and if it's a property that's used predominantly for your own use, as opposed to being let and generating income, then that will be defined as owner-occupied, not investment.
So somebody could own a batch and still rent it out for 6 months of the year?
Well, the rental thing is a question we'll have to look at, and that'll be addressed in the consultation document in terms of, what constitutes an income-earning beach property as opposed to a batch. Because if it's purely if it's rented, then that becomes an investment property.
Just following up on one of James's questions there, I can see, and you said in the report that you expect the banks to sort of meet the spirit of all this. Spiritual wisdom is not something I normally associate with banks. What happens if they don't?
Well, that's a hypothetical question. We'll talk to the banks, and our experience with the previous LVR policies that we brought in 2013, and we brought in one of the clauses is about the banks entering into the spirit of the policy, into the intent of the policy, not just the letter of it, and they bought into that, and we're very pleased with their approach. Rather than trying to undermine it, they worked with the policy, and we expect that to happen with this policy as well.
But you haven't thought about what happens if they don't?
Yes, we always think about these things, but and some of those issues will be addressed in the consultation paper.
Just quickly, if you don't get the 2 to 4% reduction in house prices that you perhaps are looking for, you mentioned before, would you take further steps? Is that something you could look at, income to loan ratios, those sorts of things?
We're always open to looking at macroprudential instruments if we believe there's a financial stability risk. We've always said that macroprudential instruments are temporary. And in essence, moving the speed limit outside of Auckland from 10% to 15% is an indication of the flexibility that we have in that regard. And hopefully we see a day that's not too distant in the future, hopefully, but time will tell, when we may be able to relax that even more. But we'll see what the data shows. We've looked at income, debt servicing requirements and that sort of thing, income to debt servicing ratios. We're collecting some of the data on that from the banks. We don't have a longitudinal history on it at this point. We're still building that up, but it is something in future that we'll do more analytical work on to see whether that's an appropriate instrument at all. But did you want to add something, Grant?
No, I think that's right. We look at the range of possible instruments, and those could be visited in the future, but no plans for other policies at this point.
Just on something a bit different, you say in the report that you're reasonably happy with the level of capital the banks are holding and their liquidity buffers. What are you going to be looking for in the review later this year? What's changed on the domestic fronts and on the global fronts to kind of warrant this?
Well, on the global front, there have been some changes out of Basel in terms of standardised approach and the approach that other countries are taking to internal rating-based capital ratios. We've also, of course, had the Australian Financial System Inquiry, the Murray Report, and the recommendation. We've seen recommendations from that to bolster the capital of the Australian banks. So we haven't seen the final policy outcome of that from APRA as yet, but we need to look at that and look at that in the New Zealand context, as well as other factors and the domestic circumstances.
And we've also been doing work on stress testing and things as well.
Otherwise, you're still reasonably happy with the capital that they're holding?
Yes, I mean, as we say, we think the capital ratios have increased substantially in recent years since the GFC, and the holdings are well above the minimum Basel requirements at this point. And we're happy that at this point the banks are adequately capitalised.
What kind of shock would it take? Is it a severe shock that they might be looking at that they can withstand?
Well, we have, I think in our last report we had the stress tests, so I refer you to the last November report last year. We talked about the sort of stress event and how that might impact on the capital holdings.
Just one quick question on the regions. The relaxing of those rules, like the speed limit in the regions. Just elaborate a little bit on that. What difference you think that might make for some of those regions where they are seeing very flat house price growth?
Well, I think as we said, in terms of the quantitative effect, the volume of house sales in the modelling that we've done, and it's the volume of house sales might increase by about 4%, and house price inflation by around 1%. But if you look at regional housing markets, there's a lot of factors that influence them in terms of just the normal supply-demand dynamics. But there's issues around demographics, there's around entry or migration outwards of young people, there's a lot about, essentially those sorts of issues. So there's a lot going on. So you might get different responses depending on, which particular regional market you're in. You tend to see quite a lot of regional variation in places like Otago Lakes and, as I say, Nelson and Taranaki, sometimes the Waikato region. So they're quite different from other regions at times. Thanks very much indeed.